All right, welcome back to Iron Financial. This is where we give you the tools you need to forge a stronger portfolio. Today, we are putting on the hard hats, and we are running a full structural analysis on a clinical stage biotech that's got everyone talking, DiaMedica, ticker DMAC. Yeah, and the reason we're talking about it is pretty simple. Wall Street, they absolutely love the story. But the charts, well, they're telling a whole different tale. So the question we're really hammering on today is this. Is DiaMedica building a real financial fortress, or is this whole thing just a pretty facade? One bad headline away from completely collapsing.
Okay, let's just get straight to the numbers, no messing around. Right now, DMAC is trading at around $6 a share. But then you look at what the analysts are saying, and their consensus target is over $15. Do the math. That's a potential 150% upside just staring you right in the face.
Whoa, hold on a second. Anytime I see a gap that wide, I don't see an opportunity. My brain screams red flag. So is this a real chance to get in on the ground floor of a new skyscraper? Or is it just a classic bear trap with a fresh coat of paint? Because let's be honest, history's just littered with stocks that had 150% upside right before they went straight to zero. The stakes here, they really couldn't be higher.
You're absolutely right. So before we can even think about making a call on this, we've got to look at the blueprint. And in the world of biotech, that blueprint is all about the core science and the market they're going after. Okay, good. Let's deconstruct this thing then. I want to see every single piece. I want to know exactly what they claim they're building. And here it is. This is the whole blueprint on one page. At the very heart of this entire company is just one single compound, DM199. It is an all-or-nothing bet on one single asset, and they're aiming it at two huge targets. First, preeclampsia, that's a really severe pregnancy complication, and second, what I'd call the main event, acute ischemic stroke. So let's be clear, we are not talking about some tiny niche market here. These are billion-dollar problems with massive unmet medical needs. This pipeline you're showing, it's literally the entire foundation for any future value. If this blueprint has a single flaw, the entire company is basically worthless. Okay, let's get into the nitty-gritty, the engineering of this thing. DM199, it's a synthetic version of a natural protein we all have, called KLK1. To put it in really simple terms, just think of it like a biological plumber. Its whole job is to regulate blood flow, right? And diseases like a stroke, well, that's basically a catastrophic plumbing failure in the brain, right? It's a blockage. So the entire scientific idea, the whole thesis of this company is that by injecting their synthetic protein, they can somehow restore blood flow to damaged tissues, whether it's the brain or the placenta. The principle is exactly the same, but it all, and I mean all, hinges on this one single mechanism working exactly like they say it does.
All right, so we've got the blueprint. We understand the basic science. Now it's time to build the bull case. This is the steel framework. These are the core arguments for why this thing could really be a skyscraper. Let's see it. I want to know if these beams are solid steel or just hollow aluminum. Are they actually strong enough to support that $15 price target? Let's find out.
The very first steel beam the bulls are going to show you is this number, $15 billion. That is the combined U.S. market opportunity. You've got $5 billion for preeclampsia and a staggering $10 billion for acute ischemic stroke. And let's be crystal clear, this isn't some home renovation project. This is like building an entire city block from scratch. The bulls will tell you that if they can capture even a tiny, tiny fraction of this, the stock goes absolutely parabolic. This is the kind of total addressable market that can, in theory, support a multi-billion-dollar valuation. The key word there, of course, being theory.
But it isn't just about the market size. It's about the competition, or more accurately, the complete lack of it. For preeclampsia, there are currently 0 FDA-approved treatments. Let me say that again, 0. This, right here, is the holy grail for a biotech investor. This isn't about building a better mousetrap. It's about building the only mousetrap. If this drug works, they're not fighting for market share. They are the market. That's that blue sky potential that everybody dreams of. It's like an empty highway with no other cars in sight.
Okay, but a great blueprint is totally useless if you don't have the funding to build it, right? Clinical trials, they burn cash faster than a rocket engine burns fuel. So this right here, this is the next major pillar of the bull case, nearly $60 million. $59.9 million in cash and short-term investments sitting right there on the balance sheet.
And that's their war chest. That's the money that's got to pay for absolutely everything. Without that cash, this whole ambitious project just grinds to a dead stop. So, yeah, on the surface, that looks like a pretty solid financial foundation.
And just look at the quality of that foundation. It's not built on a mountain of debt. Their debt-to-equity ratio is 0.01. I mean, that's basically zero.
They have not mortgaged the company's future just to pay for today's experiments.
And this is a huge, huge point for the bulls. There are no lenders breathing down their neck. It's a clean balance sheet, which to me signals disciplined management. For a project this high risk, this is exactly what you want to see. The fortress isn't carrying any heavy debt baggage.
And all of that adds up to the single most important metric for a company in this position, runway. They have enough cash on hand to last them through the second half of 2027. That means they should be able to get past their key clinical milestones without having to dilute shareholders by issuing more stock.
So the bull case is really simple when you boil it down. The fortress is fully stocked and ready to survive the siege until the final battle. It's a beautiful story. Almost too beautiful.
Okay, hold on. That's a really beautiful story you've just painted. Massive market, a super clean balance sheet, a long runway. Sounds like an impenetrable fortress.
Well, it's the bull case. It's a strong one.
It's a facade until it's proven otherwise. And here at Iron Financial, we don't just stand back and admire the architecture. We bring in the demolition crew. So it's time to take out the sledgehammers and find the cracks in this thing. Let's start the stress test right now.
Let's start with the most glaring crack in the entire foundation. Revenue. They have none. Zero. Zilch. This company sells absolutely nothing. That $60 million fortress you were just talking about, it wasn't built with profits. It was built with investor money.
Well, that's just the nature of clinical stage biotech. The value is always based on future potential.
Exactly. It's built on the shifting sands of hope. One bad clinical trial, and that hope, that so-called fortress, and all that investor cash just evaporates into thin air. Gone.
Yeah, about that $60 million cash pile. It's sitting right next to a furnace, and that furnace is burning hotter and hotter every single year. Just look at their net loss. It's not just big, guys, it is accelerating.
That's right. If you look at 2024, they burned through about $24.4 million. Fast forward to 2025, and that number jumps up to almost $33 million. You're talking about an increase of roughly 35% year over year. That is a serious acceleration in cash burn.
So that whole runway to 2027? It's a projection, okay? It is not a guarantee. If they keep burning cash at last year's rate, $33 million, their $60 million doesn't even get them 2 full years. That entire runway calculation assumes the burn rate magically stops accelerating. But all the evidence we have shows the exact opposite. The walls of this supposed fortress are literally being eroded from the inside out. So where is all the fuel for this fire coming from? Well, this table breaks it all down. And the short answer is, it's coming from everywhere. R&D expenses are up over $5 million year over year, which is about a 29% jump. Now, as the trials get bigger and more complex, you kind of expect that. But look at G&A. That's general and administrative costs. That's up over $2 million as well, also a nearly 29% increase. We're talking salaries, marketing, the whole corporate machine. The entire cost structure is just inflating. Total operating expenses jumped from under $27 million to over $34 million in one single year. That right there is the engine that's driving this massive cash burn.
And with costs rising like this, you'd at least hope for some kind of predictability from management. But when you look at their track record, it's shaky at best. They've actually missed analyst estimates in 2 of the last 5 quarters.
To be fair, they did manage a slight beat this most recent quarter.
A slight beat after a string of misses doesn't build confidence. For me, it raises a really critical question. If I can't trust their quarterly forecast, why on earth should I trust their multi-year cash runway forecast? It puts that entire bull argument on some pretty shaky ground.
Okay, now let's go a little deeper than just the headlines. Let's talk about something called the Piotrowski F-score. Right. For those of you who don't know, it's a 9-point checklist that basically measures a company's fundamental operational strength. It looks at things like profitability, leverage, and operating efficiency. A score of 8 or 9, that's a fortress. And DiaMedica score? It's a 2. A score of 2 is a major, major red flag. What that tells you is that despite all that cash sitting on the balance sheet, the underlying operations of this company are fundamentally weak. It's like a beautiful skyscraper with faulty wiring and leaky pipes.
Okay, look, those are all very valid cracks. The cash burn, that low F score, the pre-revenue status, they are all real risks, no doubt about it. But judging a clinical stage biotech on its past financials is kind of like judging a rocket by its paint job. It completely misses the point.
So what is the point then?
The catalyst, the one single event that proves whether the technology actually works or not. It all comes down to the 2026 proving ground where this entire investment thesis either achieves liftoff or it explodes right there on the launch pad.
This right here is the main event, the ReMEDy2 trial for acute ischemic stroke. This is not some small preliminary study. This is a pivotal Phase 2-3 trial, the kind that can lead directly to an FDA application. Right now, they're approaching 70% enrollment for a planned interim analysis. Now, an interim analysis is a pre-scheduled look at the data before the trial is even finished. The FDA agrees to it in advance. If the results are overwhelmingly positive, the trial can be stopped early for success. If they're overwhelmingly negative, it's stopped for futility. Let's be crystal clear about what this means. This is a binary event. There is no middle ground here. The data is either good and the stock launches into orbit, or the data is bad and the entire company becomes a crater. This is it. This is the whole ballgame.
And here's the roadmap. The company has laid it out very clearly for everyone. In the first half of 2026, we're going to get data from the Preeclampsia trial. That's a nice to have, could provide some validation for the drug. But the main event, the only thing that truly matters, is that final item on the list, second half of 2026. That is when the interim data from the big stroke trial drops. That's the deadline. That is the moment of truth. Everything else is just noise until we get there.
And you can see management is putting a stake in the ground on this. They are publicly reaffirming this guidance. They're telling the entire market exactly when to show up for the final exam. So the risk here, while absolutely massive, is not some unknown variable. There is a clearly defined window of time when this company's entire value will be rewritten for better or for worse. The fuse has already been lit, and everyone can see the clock counting down.
So we've laid out the bull case, a massive market, a really solid balance sheet, and a clear catalyst on the horizon. And we've taken a sledgehammer to it and found the cracks: zero revenue, an accelerating cash burn, and some pretty weak operational metrics. Now it's time for the iron financial verdict. After weighing all the evidence, is this thing an opportunity or is it a trap?
Okay, this is the final weigh-in, the two sides of the coin. On the bull side, you've got a $15 billion plus market with basically no competition.
And on the bear side, you've got zero revenue and losses that are getting bigger every year.
The bulls are going to point to $60 million in cash and zero debt, a fortress balance sheet.
But the bears will say that cash is completely meaningless if the trial fails. This is a binary bet, plain and simple.
Bulls see a cash runway all the way out to 2027, which is plenty of time to get to the finish line.
Bears see a low F score and a history of missing estimates, which makes you question if they can even manage that runway effectively.
And finally, the bulls see a clear, date-stamped catalyst in late 2026, a moment of truth.
And the bears see that very same catalyst as a guillotine hanging right over the stock's head.
Okay, here it is, the iron financial verdict. DiaMedia is absolutely not a foundational investment. You do not build the core of your portfolio on something this speculative. No way. This is a satellite position at best. It's a high-risk, high-reward bet on a single outcome. Think of it like a lottery ticket that's backed by science. And that $60 million in cash? That is not a permanent fortress. It's a temporary support beam. It has been engineered for one purpose and one purpose only: to hold this entire structure up just long enough to survive until the ReMEDy2 data drops in late 2026. Its only job is to get them through the test.
The foundation has been poured. The steel framework is in place. The final inspection is officially on the calendar for late 2026.
So the ultimate question we're going to leave you with is this: are they about to build a landmark that revolutionizes medicine and makes a lot of investors rich? Or is this entire project just one bad data point away from being condemned and crumbling into dust? That's the calculation you have to make. For Iron Financial, we're out.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.